$600,000. That's the number where the math of your money quietly changes direction, and almost nobody tells you it happens. Here's the strange part. Your brain hears $600,000 and files it under not enough. Not enough to retire, not enough to relax, not enough to stop grinding. And it's not your fault. Your brain has been trained on the $1 million myth. In 2024, Northwestern Mutual asked Americans how much they need to retire comfortably, and the average answer came back at $1.46 million. Charles Schwab ran the same exercise that year and got $1.8 million. Those numbers get repeated so often they've become folklore. Now hold the folklore against reality. The median American household net worth, per the most recent Census Bureau data, is $204,900. The line where you enter the top 25% of households starts at $672,700. So the target the average person believes in $1.5 million is more than 7 times what the median household actually has, and well above where the richest quarter of the country even begins. Either the entire country is doomed, or the target is wrong. I've spent more than 10 years running my own business, sitting in rooms with accountants and fiscal lawyers, watching how money actually moves, and I can tell you which one it is. The target is wrong. Or more precisely, the target was never built for you. It was built for the people who profit from you chasing it. That's the brain problem on the table. Because this channel exists for one reason. Most financial mistakes aren't math problems, they're brain problems. Your brain compares 600,000 against a mythical million and concludes, you're behind. Meanwhile, the actual math, what this portfolio generates, what it survives, what it unlocks, says you're standing at a threshold where everything genuinely flips. The gap between the feeling and the number is where people make their most expensive decisions. So here's where we're going. First, the income question. What $600,000 actually pays you once you stack it with Social Security and the newest withdrawal research, not the recycled stuff. Second, the incentive question. Why the financial industry needs you to believe it's not enough. And that's not a conspiracy theory. It's a fee schedule. Third, the question nobody warns you about the psychological flip at this threshold, where the instincts that got you here become the instincts that can wreck you. If you're new here, this is what I do. I read the boring filings and the census data so you don't have to. Subscribe if you want the numbers without the sales pitch. One honest caveat before we start. $600,000 is not a magic wand. It doesn't fund a lavish lifestyle, and it doesn't work identically for everyone. But it is a real, measurable line where 3 things change: what your money earns relative to you, how dangerous a crash actually becomes, and what your brain starts doing to sabotage both. Let's start with a number nobody argues, with what $600,000 actually does in a normal year. The number is 7%. That's the long-term real return of the S&P 500 after inflation. Behind it sit 10.2% nominal growth per year going back to 1928, minus average inflation of about 3.1%. I only ever use the real figure because the nominal one is a vanity metric. Your portfolio can grow 10%, while a third of that growth gets eaten by everything around you, getting more expensive. 7% is what actually lands in your life. Now apply it to $600,000. 7% of $600,000 is $42,000. One average year, dividends reinvested, no drama, no genius. Stock picks, $42,000 appears in your account. Here's the framing that should stop you cold. The Bureau of Labor Statistics puts median earnings for a full-time American worker at $59,384 a year before taxes. That's a human being showing up 40 hours a week, commuting, sitting in meetings, answering to a manager. Your $600,000 in a normal year earns close to what that person earns without waking up at 6:30, without asking permission for vacation, without a performance review. Your money has quietly become a worker, one that never sleeps, never quits, and gives itself a raise every single year. That's the first thing that changes at this number. Not the size of the account, the relationship between you and the account. Up to this point, you were the engine. The biggest force pushing your net worth forward was your paycheck, your savings rate, your discipline at the end of the month. The portfolio was a passenger. There's a clean way to find the exact moment the passenger becomes the engine, and the math is almost insulting. Take what you save per year and multiply it by 14. That's roughly the portfolio size where an average market year generates more than your annual contribution, because 7% of your balance equals your savings, right around 14 times that savings figure. Trivial algebra, enormous consequences. Run it for real people. Saving $15,000 a year genuinely strong by national standards, your crossover point sits around $214,000. Past that, the market contributes more to your growth than you do. Saving $30,000 a year, which usually means a solid dual income household being very deliberate, you cross at about $428,000. And if you're a high earner, $280,000 a year in household income, saving 15% of it, $42,000 annually, your crossover lands at almost exactly $600,000. That's why this number matters and why it isn't magic. $600,000 is the switch point for a very strong saver. It's the balance where even someone doing nearly everything right, top tier income, real discipline, 4-figure monthly contributions, can no longer outsave their own portfolio. The best saver in the country at this level becomes the second best worker in their own household. First place goes to the money. Below the switch, your savings rate is the whole story. At $100,000, your $1,500 a month moves the needle more than any market year will. Skipping it costs you. Optimizing it pays you. And your effort and your results stay tightly linked. That's a comfortable, controllable world. Above the switch, the link snaps. Your contribution becomes a rounding error against what the balance does on its own. Skip a month of saving and a good market week hands it back. Have your most disciplined year ever, and one bad quarter erases all of it, plus more. The variable that decided everything for 15 or 20 years, how much you put in, stops deciding your outcome. What decides it now is what the market does and what you do in response. Notice I said what you do, not what you earn, not what you save, what you do. At $600,000, your behavior becomes the highest leverage financial variable you control. And that's exactly where things get dangerous, because the same math that makes the gains bigger makes the losses feel lethal. Since 1928, the American stock market has gone through 27 or 28 bear markets, declines of 20% or more, with the average one falling about 35% from peak to trough. They show up roughly every 4 to 6 years, depending on how you count. Which means that over any 30-year retirement, you should expect somewhere between 5 and 8 of them, not as a possibility, as a schedule. Now here's where your brain betrays you again, and this time it works in the opposite direction. A 35% decline is a percentage. Percentages are abstract, bloodless, easy to hold. But your brain doesn't think in percentages, it thinks in dollars. So run the same crash on 2 different people. The person with 60,000 invested watches, $21,000 vanish on paper. Painful, but survivable. It's a used car. The person with 600,000 watches, $210,000 vanish. Same percentage, same crash, same calendar, but $210,000 is a house. It's the entire working decade of their 30s, gone in a spreadsheet. They feel minus $210,000. And that very specific, very physical feeling is what makes a person who did everything right for 20 years do something catastrophically stupid in a single afternoon. Sell everything, go to cash. Wait for things to calm down. Every one of those phrases is the dollar figure talking, not the math. But the crash itself isn't even the worst part. The worst part is a mechanism most people have never heard of. And it's the single largest threat to a $600,000 portfolio that has started paying you an income. It's called sequence of returns risk, and here's how it works. Say you retire, and in your very first year, the market drops 20%. Your $600,000 is now $480,000. Markets drop, they recover, you've read the history. Except you still need to live, so you withdraw your planned $24,000. Now look at what actually happened. You didn't withdraw 4% of your portfolio. You sold $24,000 out of a $480,000 base, an effective withdrawal rate of 5%, taken from a portfolio that now has to climb back with less money in it. The same withdrawal at the top and after a crash are not the same withdrawal. The second one scars the portfolio permanently, because the shares you sold at the bottom are not there for the recovery. Do that 2 or 3 times in the first 5 years of retirement, and you can go broke in a scenario where the average annual return was perfectly acceptable. The average doesn't save you. The order of the returns does. And I find the design of this trap genuinely dark. The moment in your life when you have the most money you've ever had and therefore the most to lose is also the exact moment your income depends on it and your nerve is at its weakest. Beautiful in the worst way. The fix, fortunately, is boring. You keep a cash buffer 1 to 2 years of your planned withdrawals, somewhere between $18,000 and $36,000, sitting outside the market. When a drawdown hits, you spend the cash and leave the portfolio alone. You never sell a single share at the bottom because you never have to. Holding that much cash, earning almost nothing, feels wasteful. It isn't. That buffer isn't an investment, it's insurance against your own forced stupidity. Which raises the real question underneath all of this: how much does this portfolio actually need to pay you? Time to run the income math nobody shows you. Start with the rule everyone quotes and almost nobody has ever seen the receipt for. In 1994, a financial advisor named William Bengen sat down with every piece of market data from 1926 to 1992, the Great Depression, the stagflation, 70s, every war, every crash, and asked a brutal question. What withdrawal rate would have survived every single 30-year retirement in that window? His answer was 4%. Pull 4% of your starting balance in year one, adjust for inflation after that, and historically, the portfolio lasted the full 30 years every time. On $600,000, that's $24,000 a year, $2,000 a month, indexed to inflation, with a century of history behind it. And the research didn't freeze in 1994. Fresh analysis heading into 2026 from Morningstar and AI Invest actually nudged the recommended rate up to 3.9% from 3.7% the year before. The reason is unglamorous. Bond yields recovered. With the 10-year treasury sitting around 4.49%, the boring half of your portfolio finally pulls its weight again. At 3.9%, 600,000 throws off $23,400 a year. Same neighborhood as Bengen's original number 3 decades later. Now let me kill a myth before it kills your plan. 4% was never a forever number. It was engineered for a 30-year retirement, quit at 65, plan to 95. If you're listening at 52, wondering whether you can pull the ripcord early, your math is different. Stretch the horizon to 40 or 50 years, and the honest rate drops toward 3.3%. Anyone selling you 4% works forever is selling you a calendar that doesn't exist. But here's the piece the $1 million myth conveniently forgets. You are not retiring on the portfolio alone. There's a second income stream, inflation-adjusted, government-backed, lasting exactly as long as you do. As of December 2025, and the January 2026 estimate is identical, the Social Security Administration puts the average retired worker benefit at $2,071 a month, not the rounded projection figures you'll see floating around the internet. $2,071, the official number, annualized. That's $24,852. Now stack them. Portfolio withdrawal plus Social Security gives a single retiree with $600,000 a combined $48,852 a year for life, both streams rising with inflation. Married? 2 benefits stack to roughly $38,500, putting the household near $62,500 a year. That is not a desperation budget. That is a funded retirement. I'll be honest about the edges, because this channel doesn't do fairy tales. The Bureau of Labor Statistics says the average household headed by someone 65 or older spends $61,432 a year, and the 65 to 74 bracket spends $65,354. So if you spend like the average retiree, the combo leaves a gap of roughly $12,500. That gap is real. It's also exactly what the frugal version of this plan closes. A paid-off home, no car payment, a zip code that doesn't charge you a premium for existing. Under those conditions, base expenses fit inside the combined income, and because Social Security covers the floor, your portfolio barely gets touched in a bad year, which means the sequence of returns monster from a moment ago barely gets a vote. What this does not do is fund rent in a high-cost city or a lavish lifestyle. That's the honest boundary of the rule. So, the floor exists. $600,000 plus Social Security covers a normal person's base life, not lavishly, covered mathematically, historically, boringly covered. Which leaves a question that should genuinely bother you. If the math works at $600,000 for a normal person, why does everyone tell you it doesn't? Follow the money. Most financial advisors in this country are paid through something called assets under management, typically 1% of your portfolio every year, forever. On $600,000, that's $6,000 a year out of your account. On $1 million, it's $10,000. Your advisor's income is a direct function of your balance, not of whether you retire comfortably, not of whether your plan works, how big the pile is. That's the whole scoreboard. Now, sit in their chair for a second. A client walks in at 58 with $600,000 and asks, do I have enough? The mathematically honest answer, as you saw a minute ago, is often yes. But yes, you have enough ends the growth of the relationship. No, you need more, keeps the deposits coming, keeps the balance climbing, keeps the fee growing with it. And I want to be precise because the internet loves a conspiracy. This isn't malice. Most advisors operate under fiduciary standards. The SEC's regulation best interest has been in force for years, and most genuinely believe they're helping. The problem is quieter than villainy. A model where the honest answer and the profitable answer point in opposite directions, and where nobody ever gets fired for telling you to be more afraid. This isn't speculation either. The White House Council of Economic Advisors documented the conflict back in 2015. And the Journal of Retirement published research in 2020 showing how asset-based fees steer recommendations away from anything that shrinks the pile, including telling a client the truth that they could stop accumulating. When a retirement calculator tells you that you need $1.5 million, ask who built the calculator. 9 times out of 10, it's a company whose revenue grows with your balance. The $1 million myth isn't a lie, exactly. It's a business model. Now here's the finding that blows the whole thing open. In 2025, researchers Blanchett and Finke published a study in the Financial Planning Review looking at what retirees actually do, not what the models say they should do, what they really withdraw. 65-year-old couples with $100,000 or more in retirement assets withdraw, on average, 2.1% per year. Unmarried retirees, about 1.9%. That's roughly half of what the 4% rule allows. Real people with real money in real retirement systematically underspend every projection the industry builds for them. The fear engine tells you that you'll burn through it. The data says the actual risk is the opposite, that you'll die with more than you retired with, having denied yourself a decade of life for nothing. Your financial advisor will not hand you this. They charge 1% a year of your assets to explain half of it, and the half they skip is usually the half about leaving. That gap is why I built the document I couldn't find. It's called The Exit Code, a digital book distilling 50 years of actual retirement data into a mathematical framework for exiting the rat race on your date, not the industry's. 2 pieces connect directly to everything we've covered. The 4% trap, why the rule, was never designed for the retirement you're planning, and the dynamic withdrawal method that replaces it, flexing with what the market actually did instead of pretending every year is average. Plus, the lazy portfolio, the allocation that has historically outperformed active traders over 30-year windows while demanding almost nothing from you. It costs less than 1 hour with a mediocre financial advisor, through the link in the description. Every year spent planning with the wrong framework compounds against you. That's arithmetic, not salesmanship. And that underspending finding is exactly why the last change at $600,000 is the dangerous one, because it happens inside your head. Here's why it happens. At $600,000, the number finally feels real. And for the first time in your financial life, the feeling is actually accurate. You're holding nearly triple what the median American household has. You're standing on the doorstep of the top quarter of the country. And even against people at their peak, the 55 to 64 crowd, the highest earning, most saved stretch of anyone's life, the Federal Reserve's Survey of Consumer Finances puts their median net worth at $364,270. You exceed that by about 65%. Against your own age group, against the country, against almost any honest yardstick, you are objectively, verifiably ahead. And that feeling, this is finally real money, is the trigger. Because feelings are terrible portfolio managers. And this particular feeling produces 2 mistakes that are mirror images of each other. I've watched both happen in real time, and they always arrive wearing the costume of wisdom. Mistake number 1 is panic protecting. You look at the balance, and a quiet voice says, "We can't afford to lose this now. It sounds responsible. It sounds like maturity." So you start moving money out of equities and into the safe stuff. Bonds, cash equivalents, things earning around 3%, because watching $200,000 evaporate in a bear market is more than your stomach signed up for. Now, run what that caution actually costs. Take a 50-year-old with $600,000. Stay invested at the 7% real return, and by 65, the portfolio reaches roughly $1.66 million. De-risk into 3% assets instead. And 15 years later, you're looking at about $935,000. The difference is roughly $720,000. That is the price of the feeling paid in exchange for never having to feel afraid. And here's the part that gets me. It felt prudent the entire time. Nobody who makes this move thinks they're making a mistake. They think they've graduated from gambling to safety. What they actually did was sell the most productive 15 years of compounding their money will ever see at the exact moment the balance was finally big enough for compounding to matter. Mistake number 2 is the opposite personality, same root cause. Coasting. The number feels real, so you relax. The savings rate that built the portfolio starts to soften, a nicer car here, a renovation there, contributions quietly shrinking because, well, look at the balance. The hard part is obviously done. Except the hard part wasn't done. It was about to start. The years right after 600,000 are the years where the compounding curve bends upward hardest, where each year of growth outweighs entire years of your old contributions. Easing off now is training for a marathon for 2 years and walking the last 5 miles because the finish line is visible. Notice what both mistakes share. In one, fear takes the wheel. In the other, comfort does. But in both, the number got real, the feeling took over, and the math got demoted to an advisory role. 2 decades of discipline, undone not by a crash or a bad investment, but by an emotion with a brokerage login. The portfolio doesn't need a new strategy at this level. It needs a bodyguard against its owner. So here is what the $600,000 rule actually demands from you. And it is the opposite of what got you here. Because everything before this line-rewarded effort, save more, earn more, the needle moves. Every dollar you didn't spend showed up in the balance, faithfully. And that feedback loop trained you to believe progress comes from action. Work harder, do more, get more. That's the world you built this money in. Above the line, that world inverts. A 20% market gain on this balance adds $120,000. That's 10 full years of saving, $12,000 annually, delivered by a year where you did absolutely nothing. And a 20% loss erases the same $120,000 whether you saved hard or not. Your effort has become statistically irrelevant to the outcome. What's left, the only lever still connected to anything, is restraint. And restraint pays better than any job you've ever had. Holding through a drawdown, logging in, looking at the damage, and closing the tab is now the highest value action available to you. It produces nothing visible, feels like negligence, and out-earns a year of overtime. Meanwhile, every active instinct is a bill waiting to arrive. Panic selling costs you the recovery. De-risking early costs you the compounding years. Spending because the balance makes you feel rich costs you the margin that makes this number work. The person who builds $600,000 and the person who keeps it are not the same person. Building it took aggression, earning, optimizing, pushing. Keeping it takes the opposite: patience, passivity, and a near total refusal to be helpful. Most people never make that trade. They bring the builder's hands into the protector's job, and the portfolio pays for it. One thing does deserve your active attention right now, and it has nothing to do with market timing. At this level, the quiet decisions start carrying real money, which accounts hold, which assets, and in what order you'll pull from them later. Tax location and withdrawal sequencing sound like paperwork, but at 600,000 and climbing, getting them wrong costs tens of thousands over retirement, and getting them right costs almost nothing today. This is the cheap window. The balance is big enough for the decisions to matter and not yet so big that every move carries a tax consequence. That window closes as you approach $1 million. So the real test at 600,000 isn't what you do next. It's what you refuse to do year after year while everyone around you mistakes motion for progress. Lazy investing built more fortune than crypto memes. Subscribe because the tax decisions that kick in at this level are next, and that video pays for itself for progress. Lazy investing built more fortune than crypto memes. Subscribe because the tax decisions that kick in at this level are next, and that video pays for itself.